Welcome back, investors. It's time that we do another second look. It's going to be a reaction video. I'm reacting to other people's analysis. In this case, it's going to be two different hedge funds and their investment letters. This is where they explain what they're doing, the reasoning behind it. They talk about some key positions, and I haven't read through this, so it's going to be with fresh eyes. I don't really know either of these hedge funds. They're just random hedge fund investment letters. But hey, if they're running a hedge fund, they're obviously taking this very seriously, putting some time into it. And it's interesting to hear other people's perspectives. And that is the whole point of this thing, is to get other people's thoughts, and I'll just react to it. I'll tell you if I disagree, if they're wrong, the reasons why, or if they're right. And I'll be the decider of that, because I'm the one that gets to decide whether or not they're right or wrong. But anyways, let's go ahead and jump in. Again, we're reacting to two different hedge funds here. And I believe the companies we're covering this time are Google, Apple, Amazon, and S&P Global. So they're going to talk about those four companies. The first one on the list is Psi Capital Corporation. This one is January 2025, so this is pretty recent. They just came out with this a month ago. Let's hear their thoughts. But let's get to the meat of it. Here's where they talk about the companies. Sundar Pichai, who became CEO of Alphabet in 2019, is currently leading the company through multiple antitrust cases. That is true. Google's being sued by everyone, but most importantly by the Department of Justice. Can't imagine that's fun, being sued by the Department of Justice. Despite these regulatory challenges and growing competition from large language models like ChatGPT, DeepSeek, Microsoft, Copilot, and Perplexity AI, we believe Google is at the forefront of the AI race and is well positioned to navigate a fast-changing environment. The company also owns YouTube, which has over 2 billion monthly users and rapidly expanding subscription business. While we have concerns about competition from AI chatbots, we believe Google Search has a strong economic moat that is underpinned by data and insights that the chatbots lack, at least for now. Alphabet owns one of the three major cloud companies, Google Cloud Platform, not to mention a number of private businesses with potential to reward shareholders richly over time. Now, I want to stop there and pause for a minute. They point out here, like, they're giving some downside in it, and I agree with this. The downside is that just in terms of finding information, ChatGPT is really impressive. I use it all the time for stuff that's like mathematical based. If I'm wanting to figure out like a coding question, something that's more instructional on how to do something, those questions are now gravitating more to ChatGPT. Google search, though, is still the place to go for pure search. If I'm wanting to find a link or a piece of information or a podcast or a show or locations and events and stuff like that, I think Google search still reigns supreme. And Google can compete against ChatGPT by improving their integration with their Gemini into search. So, but now they face real competition. This isn't Ask Jeeves. It's not Yahoo. ChatGPT is a real legitimate competitor, and they are going to take market share. Google search will lose market share, but it depends on whether the entire market continues to grow. I'm under the opinion that right now, the whole thing's growing. So even if Google search goes from like 92% market share to 90% or 89%, if the market for searching for information grows by 20%, how does that pan out? There's a lot of people that think even a little bit of incremental market share loss will be terrible for Google, but I don't know on that. I'm not convinced. I think the entire market for search and finding information, we just live and breathe information. And I think that overall growth makes up for slight market share loss with LLMs. But that is the weakest part of Google. If I have to criticize this investment, the valuation's great. The talent behind the company's great. They're getting a lot of their excess spending and frivolous spending under control. That's great. Gemini is extremely powerful. So they have it there, but they haven't marketed it as well as ChatGPT or DeepSeek. They haven't had a viral moment with it. They kind of blundered the initial release, so that wasn't good. But overall, most things about it are great. YouTube is great. It's really difficult to compete with YouTube. It just has this organic growth. And then my biggest business, the one that I love the most with Google right now, is Google Cloud Platform. This is a company within Google that is growing in revenue rapidly, 30%, while also expanding margins. So rapidly growing and expanding margin businesses are really good. It has both of them. And I think that will lift up any weakness in the search business. But it is true, they highlight really succinctly that there is competition with AI chatbots and all these different ways to get information for Google search. That is a headwind for the company. So Google right now is not the perfect story. It's not a company where I just don't see any problems or issues that they're facing. When we look at this, they highlight, we believe the Google ecosystem, supported by intangible assets, network effects, cost advantage, and customer switching costs, can propel Alphabet's overall revenue growth at a compound annual rate of around 10% over the next 5 years. Reasonable. That's your expectation. I agree with it. I think it can grow 10% over the next 5 years. I wouldn't be surprised if it outgrew that a little bit. With approximately $105 billion, 8.61 per share in cash and securities, net of debt and operating leases, the company has a robust balance sheet. Its free cash flow conversion rate remains excellent. They don't highlight here, I think, a big elephant in the room with Google, which is their free cash flow per share is declining because their CapEx investment is accelerating. So even though Google's growing their revenue, they're growing their earnings, because they're shoveling so much money into CapEx, the free cash flow has been flat. You have to decide as an investor if you think that this CapEx investment will have a high return on assets, a high return on CapEx. I think that Google Cloud has proven to be very profitable and a good return, so I remain invested in it. Now, see how they highlight the difference here with Amazon. This is the next one. Amazon was founded by Jeff Bezos, and they also initiated the position, by the way, in 2017. So let's go ahead and look at this one. Amazon was founded by Jeff Bezos in his garage in 1994, and today dominates the markets it serves. The company's e-commerce business is gaining market share, despite its immense size. While its cloud division, services division, Amazon Web Services, is by far the leading cloud provider. We estimate that AWS now generates 60 to 65% of the company's total operating profits. What a marvelous business. It's incredible. Both Amazon Retail and AWS benefit from numerous competitive advantages and deliver a high customer value proposition. Rather than leveraging its size to maximize short-term profits, the company follows a scale economy shared business model. Very similar to Costco. They're the ones that really did that. And Amazon has learned a lot of lessons from Costco over the years. Sharing a generous portion of its margin with the consumer, this creates a flywheel effect that reinforces the company's ecosystem. Amazon's approach of investing heavily in the business today to create shareholder value later masks the company's underlying earnings power. The consumer continues to shift their spending from in-store purchases to online shopping. And as data continues to migrate from on-premise servers to the cloud, we expect Amazon to grow revenue at low double-digit rates for at least the next 5 years to significantly increase its operating margins. I like what they're doing here. I like the thought behind it. One thing that they left out here that I think is a way misunderstood portion of Amazon's business, I think it's wholly misunderstood from an investment perspective, from how impactful it is on Amazon's business, is Amazon Prime Video. Like, people don't understand how big of a part of Amazon's business that is. It is a massive streaming company. Look at how big of a market cap Netflix is. Netflix alone today is one of the biggest companies in the world. It's like top 20 right now. It has a market cap of $431 billion. It's bigger than Disney, Warner Media, Paramount, all these companies combined. And it's just a streaming company. And here Amazon is, they have one of the biggest. It's like the second biggest after somewhere between Netflix and Disney. And people don't even mention it. They don't even bring it up as a thing in the investment. They bring up AWS, of course. They bring up the retail business. They didn't directly mention the advertising business, but they couple that with retail. The Amazon Prime Video business is massive. The profits behind it is massive. Andy Jassy has frequently said in his earnings calls that the Prime Video portion of the business, we believe will be, I can't remember the exact phrasing, but we believe it will be highly profitable high return investment in and of itself. And Netflix has proven that. Now, they have the advantage of also running ads on all their content. They just put ads on everything. Netflix is like, we can't do that. We're just going to come out with a new ad tier that's much cheaper than the normal tiers, $7 a month starting. We just bumped it to $8 a month. Amazon Prime's like, the heck with it. Ads for everyone. You have to pay extra to get out of the ad tier. So to put this in perspective, the Prime business it's like a sleeper portion of Amazon. Nobody cares about it. The Amazon Prime Video portion, nobody cares about. Management has says it's going to be a massive profitable business. Andy Jassy, in fact, there's a analysis, it wasn't directly from management, but there's a third-party analysis that estimated that around 70 to 80% of new signups for Amazon Prime, just the general membership for the 2-day shipping and all the various stuff, they sign up because of Amazon Prime Video. They want to watch a show, they sign up for Amazon Prime, then they get locked into the Amazon ecosystem. It's massive, it's important. I think that the Psi Capital, whatever this firm's name is, they never mentioned it here. It gives me the impression more and more as I don't hear people talking about this, that it's just a forgotten part of the business. To me, it's extremely impactful. It's one of the 4 pillars of Amazon. I think the company has so much opportunity, and the parts they mention is just part of it. Let's go ahead and move on to Apple. They purchased it in 2016. That was a little bit before I purchased Apple. Apple is one that I, again, purchased really late 2017, December of 2017. We initiated our investment in Apple in 2016 and elevated it to a core holding in 2018. The same year the company introduced its redesigned 13-inch and 15-inch MacBook Pro model. Apple has consistently redefined innovation in hardware and software. The September 2024 launch of the iPhone 16 with its groundbreaking AI capabilities include enhanced image generation tools marks another inflection point. We believe this transformative device is the foundation for AI-driven supercycle that could entice approximately 100 million consumers to upgrade, reinforcing Apple's leadership in the industry. Today, Apple's ecosystem spans over 2 billion active devices, supported by a rapidly growing base of subscription services. This strategy has helped to turbocharge customer engagement and spending. In the most recent fiscal years, which ended in September 2024, Apple's high-margin service division accounted for 39.3% of total gross profits, up from 32.8% just 2 years ago. Apple's financial footing remains exceptional. With approximately $50 billion in net cash and marketable securities, looking ahead, we expect earnings per share growth to outpace revenue growth, driven by margin expansion and continued share buybacks. Okay, we're a little bit at odds with each other here. I think this is a very eloquently said and really intriguing. I think it's a really good case for Apple. I like hearing this, and I agree with most of it. What Apple's done is just incredible, and you have to give them credit for what they've accomplished over the past 6 years. They won the game. They've been better than most companies. They've just driven more success, more shareholder creation, better capital allocation, more organic growth with their products. And even though they've had a couple misses, that's not something rare for Apple. They've had misses before. I look at it and I think the problem with Apple is that even on the growth rate assumptions right now, that Apple's giving themselves their own growth rates, they're growing in the low to mid single digits is the way that they phrase it, which means they're growing at like 4% revenue per year. I'm looking at companies, I want them to grow at a minimum 8% per year, hopefully like 10 to 12% per year. And then I have many companies growing 15% per year, but 4% per year, that's hard for me to swallow. I really have a tough time having a company in my portfolio that not only has grown slowly for the past couple of years, but it's projecting slow growth for the next year at 4%. So at the end of the day, I do agree that it's a wonderful company, one of the best in the world. I'm a huge Apple fanboy. I love the products they make, but I have to have a viewpoint of my portfolio. It's an all-star team, like a sports team. It's not a family. Families you stand by and you have a relationship with them. You know, you never kick them to the curb, that type of thing. But a sports team, you have to have top performers on your team. And if they're not performing, you have to replace them with someone else that is. Apple's a company that I think is just a bit slow right now. I think there's better options. So that's the reason I'm not in it. But I understand why people still are in the company. Overall, I really like the portfolio. Obviously, big tech concentrated. A lot of hedge funds try to avoid big tech at their own peril and demise. Trying to circumvent big tech and outperform it is a feat in and of itself. It's much easier to ride the best companies in the world and then pick a few that you think will do better outside of that. So I like the strategy here. I like the research. Some minor disagreements here, but overall really good. Now let's go ahead and move on to the next one here. This is from a investment firm called Wedgwood Partners, Inc. I don't know anything about them. Maybe they like golf. You got your wedges and your woods, right? Maybe they like golf. So that would be my guess. The Wedgwood investment firm. It's Wedgwood Partners fourth quarter 2024 client letter. Now, the one that we're covering on this one is going to be S&P Global. So we'll go ahead and scroll down to that. S&P Global is an interesting one to me because I have over $100,000 invested in this company. They just reported earnings. These guys didn't know about the earnings they just reported. This was released before that report. But let's go ahead and look at it. S&P Global. Look at that. Beautiful. 540, up 5% after earnings. They just nailed it. S&P Global is such a great company. They raised their free cash flow estimate for 2025 to $6 billion or $5.9 billion. So they're doing great. This letter came out before the most recent quarter. Wedgwood has owned S&P Global for just over 5 years. It has been a somewhat unusual holding in that we took an initial position of just 2.5% 5 years ago in late 2019, and we have neither added nor trimmed our position since. I love that. They just bought it once and they're like, we're done. We're never going to touch it again. We'll just see what happens. I haven't even done that. I added more when it dips. I can't help myself. When I see one of my top holdings and it's dipping, I usually like buying in. It's time to provide an update on the company. Many of you will remember that S&P Global used to be known as Standard & Poor's, long known originally as a credit agency and a go-to source for financial information. Founded in 1960s by Henry Vernon Poor, the origin of the company was a series of books published by Poor providing financial and operating statistics for U.S. railroads. Decades later, Luther Lee Blake founded the Standard Statistic Bureau, rather brilliantly hitting on the idea of doing what Poor did, except covering every industry in the U.S. One may chuckle that this was a time and place nearly unfathomable to many of us in the investment profession when all the financial data we would ever need was not available at our fingertips on PC, laptop, or smartphone. Standard, for example, delivered financial information about companies on, would you believe, index cards, which were updated just several times per year. We assume your intrepid investment professionals of a time would consult something like a massive Rolodex of index cards to evaluate potential investments for clients. Junior analysts would get the job of slipping and updating card information. Over time, a series of business combinations first brought the two companies together in the 1940s. They then passed through the publisher McGraw-Hill for several decades before a variety of investment banking deals eventually split the company into multiple pieces, leaving us now with S&P Global, roughly returning to the heritage of the old Standard & Poor's. The business today offers a variety of information services, including critical bond rating business, where it effectively operates as a duopoly with longtime competitor Moody's. Additionally, S&P Global runs a highly profitable market indices business and provides broad market and commodity market data, among other services. When we first purchased the stock, we highlighted our belief that the company could continue to grow revenue at a healthy mid to high single-digit percentage range, with opportunities to improve its already outstanding duopoly-like profitability, leading to consistent double-digit earnings growth. We expected the flagship rating business, which generates roughly half of the company's profits, to be long-term beneficiary from these seemingly perpetually low interest rates at the time. As central banks were also helping to spur the market by actively pushing corporate debt. The market intelligence segment, a low-price information service offering, was expected to grow its user base as it extended its customer base, reaching beyond financial industry verticals. Additionally, passive asset equity flows, including the growing ETF market, were expected to drive the higher profitable industry segment. Looking back over the past 5 years, we say that little has changed in our thinking about the company during our holding period. Oh, thank goodness. I thought they're going to be like, we thought all these great things, and then now we don't think so. Like, it's changed, or the quality's gone down, or something like that. I thought they were going to throw me a curveball there, but no, they're saying the exact same thing. I thought they would, because if you look at S&P Global, if you look at what S&P Global said 5 years ago, and their forecast they give out every year, they've surpassed their forecast every single year. So how can investors be disappointed? When a company says, hey, we're going to go and accomplish this, and then they come back and said, here's the report card, we did even better. How can you be disappointed in that if they're repeatedly, like clockwork, surpassing all their expectations? If you look at 2024, for example, compare, and maybe I'll do this sometime, but compare the forecast they give in going into 2024 and then the actual results, and they did much better across the board, especially the most meaningful metrics, they did much better. So it makes sense that they say little has changed in their thinking because S&P Global has been executing. I thought they might throw a curveball here. Again, I haven't read this in advance, but I'm glad they didn't. Little too has changed about the company's strategy or operations either. However, the shocking outbreak of COVID-19 shortly after we initiated our holding led to several years of exaggerated economic swings and aggressive government policy responses, meaning that just about nothing has been normal between 2020 and 2023 in relation to the company's market conditions. While stock performance has been reasonably solid over the past 5 years plus, the stock has lagged the Russell 1000 Growth Index and the S&P 500 Index. The stock has been a relative loser for us over the entire holding period. So you might ask, very reasonably, how can we say that our thinking hasn't changed? And why still have optimism about the business? This is true. S&P Global underperformed the market and the S&P 500 in 2024. It was one of the things that actually dragged my portfolio. I had other stocks that did great, but S&P Global did average. It was an underperformer. But the business, what they're going to say, I don't even need to read it. The business intrinsically, the free cash flow per share, the earnings per share, the revenue grew faster than the market. So you have a business where the intrinsic value is increasing at a more brisk pace than the market, and the share price is behind the market. So I think that's what they're going to reference here, but let's take a look. First, the fundamental performance has actually been quite good during our holding period. Revenue and earnings per share has accelerated during the first few years we held the stock, although there were benefits we had not anticipated from early government and central bank responses to COVID-19. As you can see in the table below, once central banks started raising interest rates to fend off significant levels of inflation, that surged across the world. Capital market activity dried up. After a period of artificially high activity, leaving the company and many other businesses with a bit of air pocket in 2022. However, moving into 2023 through 2024, as central banks began cutting interest rates again, you can see too that the business picked up again, growing at rates comparably favorable to the period just prior to our original purchase in 2019. Our primary argument for the stock is that the business model is a winning model in anything resembling a normal market. Much of the business is driven by changing interest rates in corporate debt financing. While most evident in the flagship rating business, where lower rates encourage entities to seek more borrowing, most markets generally will be more active when rates are lower rather than higher. Lower rates beget greater capital formation, higher valuations for all types of commodities, and attract more participants seeking information and opportunities to buy or sell. So low interest rates indirectly or directly affect every part of S&P Global's business, their commodity insights, their market intelligence, and of course, their credit rating business directly. It's not just the credit rating business. And I like that they highlight that. It affects all portions of the business. Many of you will also know that the United States, plus much of the developed world, has been in a loosening interest rate environment for much longer, decades in fact. So we can see that since the 80s, interest rates have been on a steady decline. There's a lot of thoughts behind this of what's causing it. A lot of people believe it's like technology is a deflationary thing. So even though we had some inflation recently due to fiscal policy, the long-term secular trends of technology will further deflate things. Setting aside arguments about the rationale behind long-term Federal Reserve and federal government policy, or any near-term debates about how likely outcome of policy decisions by the incoming Trump administration, we argue that there is a clear long-term bias in favor of loose fiscal policy. One only needs to see the market and the Fed's recent fascination with bringing interest rates back down again, despite a fairly healthy economy and above target inflation. While low interest rates have been a tool for stimulating a struggling economy, it seems that too many participants now view low interest rates as the default. If we and the 50-year chart laid out above are correct, we would argue that the last 5 inconsistent years of interest rate, debt issuance, and capital formation are an anomaly rather than a long-term trend. And we would expect S&P Global's business to experience a more favorable environment over the next several years, as well as debt refinancing loom in the next few years. This has been the story with this company. When Wall Street are making their discounted cash flow, they're doing their analysis, they're coming up with their earnings estimates for next year. They're doing just that. It's next 12 months earnings estimates. So you have like a team of people at these big banks. The analysts are sitting there running thousands of DCFs a day, right? They're just going through with their spreadsheets, coming up with what they think these companies will earn over the next 12 months. And what they're not really factoring in is on a long-term secular basis, there's going to be huge walls of renewing debt. There's this long-term trend of lower interest rate, and that will be a boon for this type of company in the future. So that's where you get alpha from this type of holding. And you see the big wall of debt maturing over time. Let me zoom in on this. That's going to be a lot this last year. So you saw it recover, but then 2025 is going to be even more. So we're going to see this business go up like crazy, the high margin portion. Then 2026, a little bit of decline in 2027, then a huge amount in 2028. What I see here is a lot of money for the S&P Global shareholder over the next 5 years. This leads us to one other factor in our investment in S&P Global. We believe the drivers of the company's business provide a modest hedge to our investment process. Our valuation and profitability disciplines, coupled with a large cap growth benchmark dominated by technology stocks that often do not match either of these disciplines, can combine to make it difficult for our process to beat said benchmark in the strongest market rallies. They're saying that they don't own big tech companies, which again, I think it's terribly difficult to outperform the QQQ and the S&P 500 without owning any big tech. Just my opinion on that, but they don't own big tech companies and high growth companies that are tech. And so they miss out on these market rallies that are tech oriented caused by low interest rates. The tech companies just take off. Their returns by comparison look really rather mundane. So that's what they're pointing out there. Now they say these rallies often coincide with declining interest rate cycles, or at least expectations of declining rates, just as seen in 2024. Thus, we believe it is helpful to own an attractive, profitable growth business such as S&P Global, especially because its largest rating segment tends to be supercharged by declining rates. While we wouldn't own the stock for only this reason, we do appreciate that this high quality, remarkably profitable, and near monopolistic business model tends to perform better in environments where the investment processes tend to have a relatively more difficult time. They're saying that they don't own a lot of these high growth tech companies, and S&P Global is like a hedge against that. Because if we have a crazy market infused, low interest rate, investment infused environment, S&P Global is going to have major tailwinds because of that. All their business is going to rise. Their commodity ratings, their investment insights, and of course their credit rating business will do exceptional. So this is a hedge against their value-oriented strategy. S&P Global is like the perfect mixture of kind of a value-oriented company, very modest, kind of stodgy company, but it has supercharged growth during low interest rates. So it can kind of hedge against that. So I like the reasoning there. That's not why I own it. I own it because of all the different reasons. The monopolistic business, remarkably profitable. I think it's going to do really well on any normalized basis. But there you go. There's my reaction to these two different hedge funds and their investment cases for these companies. If you want to see more videos like this, especially exclusive ones as well, you can check out the Patreon. But if not, I'll see you in the next video.